their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, you don't really need any cash.
So you can be more cash-free than Berkshire is.
Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that, would happen. All kinds of things where we might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children were grown, the house was paid off and everything. But, I wouldn't worry too much about having a lot of cash around.
I'll let Charlie have that first question about the cost of capital, which has puzzled people for thousands of years. And then
the way that is taught in most business schools now, I find incoherent, and so I'm the one that asks that question and gets the incoherent answers. I don't have a good answer to a question I consider kind of a stupid question. What is the cost of capital at Berkshire Hathaway when we keep drowning in this torrent of cash which we have to reinvest?
There's really only two questions that get to that, but you don't need a mathematical answer. The first question is when you have capital, is it better to keep it or return it to shareholders? It's better to return it to shareholders when you cannot create more than $1 of value with that capital. That's test number one. And if you pass that threshold that you think you can achieve more than $1 of value for every dollar retained, then you simply look around for the thing that you feel the surest about and that promises the greatest return, weighted for that certainty. So our cost of capital is, in effect, measured by the ability to create more than $1 of value for every dollar retained. If we're keeping dollar bills that are worth more in your hands than in our hands, then we've exceeded the cost of capital as far as I'm concerned. And once we think we can do that, then the question is how do we do it to the best of our ability? And frankly, all of the stuff I see in business schools, and I've not found any way to improve on that formula. Now, the trouble that you may have is that many management...
He's certainly right that all the choices are lousy for short-term money now, but we don't play around with short-term money. So we did not own commercial paper in 2008 before problems occurred. We did not own money market funds. When I say we didn't own them, there may be small amounts at various subsidiaries, but in terms of the big money, which we run out of Berkshire, we basically keep it in treasuries. And we get paid virtually nothing now for it, and that's irritating. But the last thing in the world we would do at Berkshire is to try and get 5 or 10 or 20 or 30 basis points more by going into some other things with our short-term money. It is a parking place. It's an unattractive parking place, but it's a parking place where we know we'll get our car back when we want it. And when we need, certainly the case in September of 2008, we had committed for some time to put $6.5 billion in Wrigley when the Mars-Wrigley deal occurred. And we certainly didn't contemplate at the time we made that commitment, which was probably in the summer, that the events would take place like they did in September. But we had the money. I knew I had to show up with $6.5 billion. I think it was on October 6th. And I had to show up, and I couldn't show up with a money market fund or some commercial paper or anything of the sort. I had to show up with cash. And virtually the only thing I feel good about in terms of having large amounts of ready cash is Treasury bills, and that's where we've got. If you look at our March 31st statement, I think you'll see $38 billion, and overwhelmingly that will be in Treasuries. Charlie, I don't think we'll hit any home runs under any circumstances, but you might consider a normal level of cash at Berkshire as being about $10 billion. Although there could be circumstances where we'd go below that, but because of the catastrophe insurance business we're in and all of that, we do not scrape the bottom of the barrel, but we don't need anything like $40 billion. I think you'll see in the 10Q that we have, I think it was about $37 billion at the end of March. Double check that. And I'm not counting the cash in the finance business. Yeah, 37 something. And we're spending $4 billion on ISCAR. We're spending some money on some other things as well. But we would be happier, much happier, if we had $10 billion of cash and all the balance in things that we liked very much. And we work toward that end at all times. But there is nothing even about the way businesses come to us. We've got one idea at present, low probability, but that would could take as much as $15 billion or close to $15 billion of cash. And whether it comes to fruition or not, who knows? But we do work on them. And what we care more, we don't like having excess cash around. We like even less doing dumb deals because we do them forever. I mean, if we make a dumb deal, it just sits there. We don't resell it 3 months later by having an IPO of it or something of the sort. So you're right to say that we should be very uncomfortable about the fact that we've got the cash, but it's also important that we not be so uncomfortable that we go out and do something just to be doing something. I would say it's likely, but far from certain, that 3 years from now we have significantly less. But far from certain that 3 years from now we have significantly less cash, and I hope significantly more earning power. But the goal of that cash is to be translated into permanent earning power over time. Like I say, with the $4 billion that we've just committed on ISCAR, we love having that $4 billion employed there instead of sitting around in short-term securities. And that's our job. Charlie and I don't do anything else except appear in movies and that sort of thing. But you're right to keep jabbing us on that because, but we jab ourselves. Neither one of us basically likes cash. We always want to have adequate cash, and we always will have adequate cash. And we are the biggest player in the world in cat insurance. And people come to us because they know we're going to run a place that's very strong financially. But it doesn't have to be as liquid as we are now. We spent $5 billion. Well, we didn't spend that much. At the Berkshire level, we spent about $3.5 billion on Pacific Corp. Now, we contracted for it a year earlier, but we will get more chances, I think, in that field, but you never can tell when they'll come. So come back next year, and I hope we have less cash. Yep. Oh, really? Oh. So, okay, well, we'll go to 13 now. Okay, Charlie, would you like to add anything on that? And then we'll...
Well, yeah, I think you may get some perspective on what bothers you. If you go back